What's good? Welcome to Market Takes. I am your host, Dion Rabouin, reporter at the Wall Street Journal. Today's a big day, man. If you've been watching the markets, if you've been reading the headlines, if you're paying attention at all, you know today is a big day. And we are breaking down some of the big data. This isn't data that normally makes a lot of waves that investors are normally talking about, but retail sales and PPI today have made some big moves in the market. We're going to explain what happened, what the data showed us, and how it all comes together with all this news about bank runs, bank failures, the economy, the market, stocks, bonds. We are breaking that all down right here on Market Takes. Listen, first of all, we are going to show you what the reports showed. We've got some charts up there so you can actually see what's going on, how this data is moving. We're going to break that down for both retail sales and PPI, aka the Producer Price Index, aka wholesale prices, aka here's what businesses are paying. We're also going to talk about the market reaction. We're going to go through the market, stocks, bonds. We're going to talk Fed fund futures. We're going to nerd out a little bit. Y'all keep coming on the comments telling me you want me to nerd out. We're getting into Fed fund futures today, baby. So be careful what you wish for. We're going deep. We also, of course, are going to talk about the market environment coming in, the economic environment coming in, what was happening around the world and here in the US that made these reports such an impactful release today. We're going to talk about all that. Of course, we're going to talk about these bank fears and bank runs. We're going to talk a little bit about Credit Suisse, so y'all know what's going on. And of course, we're going to talk about the Fed expectations and how this influences the Fed, because if you're not watching the Fed and central banks, you're not an investor right now. Go play Pokemon. This isn't for you. Anyway, and of course, we're going to tell you what comes next and what to watch for. We're going to be doing market takes for the Fed meeting next week, so I want you to be right here. But before that, we got to get into today and what happened. So first, let's talk about U.S. retail sales. After the biggest increase in close to 2 years, we saw a negative number on the retail sales. Today's report showed negative 0.4% contraction month over month and a 4.6% increase year over year. So I want to throw this chart up here of retail sales, and here's what we're seeing. Now, that number on the far right of your screen there, that's the February number we got today, negative 0.4%. Now, when you look back, that January number, that 3%, that could have suggested, okay, maybe retail sales are starting to pick back up. Maybe consumers are going out spending again. Well, now it looks like we've got a bit of a theme. Look at December, look at November. Those are the 2 months previous to that big spike up. And then you go back to September, you see another decline. And then you see another decline a couple months before that. It's looking like we are seeing a defined trend now, a trend of lower numbers on those retail sales reports, right? And that could tell us that consumers are starting to pull back. Maybe they're starting to tap out. Maybe consumers are saying these prices are too high, I'm pulling back. That's bad news for the overall economy, but could be good news for markets and good news for the Federal Reserve. So just wanted to throw that up there to kind of illustrate so you can see the overall theme that we've been seeing over the past year or two on retail sales. Now, this contraction really kind of puts that January number as a bit of an outlier, and it tells us that we're returning to that trend that we saw overall for retail sales being lower, being negative. That's not a great thing if you're running a business. That's not a great thing if you're out there trying to sell your products. So keep in mind that this number for retail sales, not such a good thing. It's good on the inflation front, not so good on the recession front. We'll be talking about both of those here in just a minute. Let's talk about PPI, the Producer Price Index. I want to throw that chart up there. And now the chart you just saw for retail sales was month over month. This is year over year. And I showed the difference up there so that you can see how prices are changing year over year for the Producer Price Index. Businesses are paying about 4.6%. That's a 4.6% growth year over year. But what you're not seeing in that chart of overall price declines over the past couple of years, or overall price increases, over the past couple of years, is a 0.1% contraction month over month that we saw for February from January in PPI. Now, this was well below expectations on the year over year number, the month over month for core, all of that stuff. But what you see there on your screen is a very clear wave down from that peak that we saw in about July of this year. we have just come down and down and down. And why that matters is PPI is the precursor for CPI. So just wanted to put that up on your screen to illustrate kind of the overall trend, and what you're seeing is prices coming down for businesses. We know that businesses have consistently passed those price increases on to consumers and raised prices very fast, and actually raised prices at a greater level than what they're paying. So when we see this come down to 4.6% year-over-year inflation on the PPI level for businesses, that likely means that overall consumer price inflation can continue to fall even further. Gonna get into some details for you just a little bit. Like I said, y'all asked me to nerd out in the comments. We're getting into these details. The core was 0.0%, 4.4% increase. That is a big miss. Core was expected to rise 0.4% and 5.2% year over year. Just know that's a big miss on the core number. The PPI for goods, which makes up about 31% of the total, was also negative 0.2%. PPI for services down about 0.1%. Services 67%. All those numbers mean is that services are a bigger part of the economy, about 2/3 of this report, and we're down less than goods. Why does that matter? The Federal Reserve has zoned in on services. They've said we're watching services because we know goods prices are coming down. We've seen the ports clearing up. We've seen a lot of these supply chain issues clear up. Now we're worried about services, and services is coming down less than overall prices for goods, but services is now only 3.8% on the year. That's a good sign when it comes to inflation coming down. So overall, today's reports were good news on the inflation front. We are seeing inflation coming down, moving back toward the Fed's 2% target. That's good news for markets, good news for investors, good news for business people. Here's where things start to get a little sticky. Actually, you know what? Getting a little ahead of myself. There is some more good news. A couple people in the comments yesterday were really excited about egg prices. I got invited over for some omelets and frittatas. Don't think I'm not going to take y'all up on that. But a big piece of this report that I don't know if everyone caught, my man Lou Breen over at DRW Trading pointed this out to me. He says that over 80% of the February decline, 80%, 80, in the index for final demand goods can be attributed to a drop in prices for chicken eggs. So chicken egg prices, remember, everybody's been complaining about egg prices. Egg prices too high. Cardi B talking about lettuce, eggs. Oh my God, this is crazy. It's on Twitter. It's on your feed. Everyone's saying egg prices are crazy. Well, egg prices fell off a cliff this past month in February, and they dragged the overall prices for food down and made a huge impact on the price for final demand goods. That's big. Overall, this suggests that CPI could be coming down in further months. And again, we saw yesterday, if you watched the live stream yesterday, if you didn't, go back and watch it after we're done here. But yesterday when we looked at CPI, we saw that shelter was a huge part, about 70% of the increase in overall CPI. And that suggests, well, shelter is a lagging indicator. We know shelter prices come in late, and they can be something that, you know, the Federal Reserve is saying, hey, we see rent prices coming down. We see the prices that people are paying for homes coming down. We think shelter prices are coming down. Well, that suggests, again, another sign that inflation is coming back down. This is good news for the overall economy. So we've talked about the economy in terms of inflation. The other big piece of that is recession and recession fears, and that looks to be what's moving the market today. So we're going to check in on the overall market. We're going to talk about stocks, bonds, FX. Everything is moving in a big way today. We've got the S&P 500 down about 1.3% right now. NASDAQ is actually down the least, down about 0.9%, and the Dow is down 1.4%. Real worries about the real economy, what's moving things right now. Obviously, Credit Suisse and bank fears and all that stuff, we're going to get into that in just a minute. But when we look out at the market today, we are seeing a significant change in expectations for the Federal Reserve. If you look at the short part of the yield curve, we're talking bonds, you know how I love to talk bonds. Now, if you look at the yield curve right now in the short dated place, that's 3-month bills, 6-month bills, 1 year, 2 year, there has been a huge just jumping off a cliff decline in the yield of bonds. We are seeing the 2-year note now down at 3.78%, well below 4%. Just a couple weeks ago, that was at 5%. So we have seen in just a matter of days, really weeks, that we've gone down over 100 basis points on the 2-year yield. That is a huge move. The 1 year down at about 4.11%, and the 3-month at 4.79. Basically, what the market is saying is they don't expect the Fed to raise rates anymore. In fact, you're looking at a rate cut expectations going forward as we look out into the future. When we look at Fed fund futures, the Fed fund futures market just yesterday, just a couple days ago, had been pricing in a 50 basis point increase for the Fed. The Fed was going to raise rates at twice the rate they normally do. Now, that's out the window. When you look out at the Fed fund futures market, the market is saying, no, we think not only is the Fed not going to raise 50 basis points, we don't think they're going to raise 25 basis points, which was the normal pace for about the past 20 years. We think now they're going to hold pat, not raise rates at all, 0% move, and that's factored in at 60%. When you get out to December of this year, Fed fund futures for this year are projecting a full 1% rate cut. So they think the Fed is going to cut rates by 100 basis points after this data today. That is huge. That's big for stocks, bonds, commodities, everything you can think of, because the market is now saying we think this Fed rate hiking cycle is over and we think they're going to start having to cut rates into the future. That is big. That suggests that all this trouble with the banks that we're seeing is really playing a role, and this inflation data that we've seen yesterday and today, which says that inflation is coming down, that's going to move the Fed, and we know the Fed moves markets, the Fed moves the economy, the Fed is everything. The Fed really has taken control of this economy since March of 2020, and they're expected to kind of back off and eventually start moving in the opposite direction. So let's talk about the overall market coming in. I know y'all have heard about those Credit Suisse headlines, down about 25% on the news. Let's take a look, rather than just talking about Credit Suisse as an individual stock, let's take a look at the overall bank stocks. I want to throw up here on your screen the KBW Bank Index. We looked at this yesterday and the huge move that you had seen over the past few days, right? In just 5 days, the KBW Bank Index was down about over 20%. And that's more than it's down year to date. That's about 2/3 of the entire decline over the past year. And you saw a little pickup yesterday. It was something of a relief rally. You saw First Republic jump about 45% at the top of its rebound. You saw a lot of stocks moving higher. But overall, when you see just that little incremental pickup there at the end of your screen, that tells you that traders aren't all the way in, that there is still worry about a lot of these bank stocks. And what we're seeing today is that KBW Bank Index is down another 3%. So just wanted to put that up there to illustrate the market sentiment and the market themes. Overall, investors do not buy the story that banks are not in trouble. We are seeing worries about banks, and we are seeing the Fed expected to take action. This is all very big and very big news. So listen, the inflation narrative, we talked about that. PPI down big. CPI was looking like it's moving, but that shelter component suggests that it's got further to go and we could see bigger declines in the future. The recession narrative, that's what's also priced in. If consumers aren't buying things, if retail sales aren't rising, if they're declining. Inflation is still rising at about 6% according to the CPI. So if prices are rising at 6% and consumers are spending less, that's not a good sign for the overall economy. That's increasing fears about recession, that the economy could be in trouble, along with, in addition to, some of these fears about the banks, because we know so go the banks, so goes the economy, because the banking structure is so written into and so integral to the U.S. financial markets and the overall U.S. economy. You guys remember 2008. Not saying we're there, not saying we're there, only saying that to point out the importance of the banking sector to the U.S. economy. So that brings us to the Fed, the Federal Reserve. Expectations from the market for them to hold pat, not raise rates at their meeting, 0% hike, aka no hike. We are getting to the hard part. The easy part was for the Fed to raise rates because inflation was rising, right? Inflation rises, Fed's got to raise rates to get inflation now. Now we're getting to a place where the Fed has decisions to make, where we're actually going to see some arguments, some back and forth. We're likely to see some dissents in these decisions made by the FOMC, the operating committee of the Fed that decides policy. Barclays and Goldman Sachs both say the Fed is going to hike 0%. The market had been disagreeing with them, factoring in about a 55% chance for a 25 basis point hike. Now that's off. Market says 60%, no hike this month. They're not going to move after today's data. The bond market also, when you look at those big declines in the 1 year, 2 year, the 6 month, and the 3 month, those are all saying the Fed's not going to move. We are not seeing those same moves in the 10 year, in the 30 year, in those long dated bonds. And that's why you're seeing what they call yield curve compression or yield curve flattening. It's a bear flattening move if you want to get super technical about it. Y'all asked me to nerd out, so we're nerding out. But we're seeing that bear flattening is in yields on the shorter end of the curve, short dated bonds coming down way faster than the long dated. That just shows investors are saying the Fed's not going to move. They're going to start cutting rates. And that is not even being factored in as good news for the overall economy. Real recession fears being played out in the market. Listen, the Fed has had some real problems with its forward guidance, with its credibility being taken seriously by the market. Next week is a huge meeting for Fed Chair Jerome Powell and the FOMC. You're going to want to watch that, and you're going to want to be right here for Market Takes. We are going to be breaking it all down March 22nd, 4 p.m. after markets close. We are going to be right here with Market Takes. I hope you'll be with us. The Fed discount borrowing report is out on Thursday. Be sure and watch that because that's going to be big to tell you what these banks are doing. Michigan consumer confidence, that's out on Friday. Be sure and watch that, and be sure to be here for Market Takes next Wednesday. That's a week from today. Listen, that's going to do it for Market Takes today. I'm your host, Dion Rabouin. I know you could have been anywhere in the world, but you were here with me, and I appreciate that. We'll be right back here on Market Takes next week. I hope to see you there, and we'll do it again next time.